Hi, it's Harry Dent. A lot of our subscribers and people at our Irrational Economics Summit are all asking me, Harry, what's going to trigger, what's going to burst this bubble? Because obviously governments and central banks keep finding a way to print more money and to stimulate in more ways. They don't want this bubble to burst, and for obvious reasons. They don't want to have the Great Depression on their watch, because you'll go down in history as Herbert Hoover. So obviously I've talked for the last few years about China. Greatest bubble in modern history. They've moved 230 million people in a decade and a half, the fastest rate from rural to urban areas. These people have no skills, and they're sitting in cities, and the only reason they're working at all is because they're building stuff for nobody. And 27% of condos are vacant, 30 to 50% excess industrial capacity. China has built their economy for the next 15 years today. You can't keep doing that with the world slowing down. Germany, we keep warning, going off a demographic cliff from 2014 to 2022, even steeper than Japan saw in the 90s. And Japan had a major collapse in its stock market, 80% ultimately, 60% collapse in the real estate markets. Their bubble burst, even though the rest of the world was having the greatest boom in history, which we also predicted. We see the wealthy slowing in their spending 2015-16 forward. We see car sales collapsing 2015, especially 2016 forward, just like home sales did before. These are all things that could go wrong, but we keep reminding people of something that most people are missing. Commodity prices keep collapsing around the world. Now, we predicted this years ago. The commodity prices are ready for a major 30-year peak, one of the most reliable cycles we have, and they peaked in mid-2008 and then a secondary peak in early 2011. Ever since, commodity prices have been down. The CRB, which measures them down, commodity prices here in late October are down 43% from their top already. Now, why is this important? Emerging countries, most of them, not as much India maybe and parts of Southeast Asia, but most of the Middle East, all of Africa, parts of Asia, these countries rely on exporting commodities. Their stock markets are disproportionately weighed towards their largest exporters and the financial institutions that finance them. They're not as representative of their whole economy as, say, the S&P 500 is in the U.S. I find this even in Australia and Canada, where I lecture a lot, because they are developed countries that have a high percentage of commodity exports. So commodity prices going down is the final nail in the coffin. And it's related to China. It's because world growth is slowing. And China and the emerging countries are the biggest consumers of commodities. And it's the biggest part of their economy. So this is linked. Now, one of the things I've shown in recent years, emerging markets, and I use the EEM ETF, an index that measures emerging countries altogether. That is down 29%. And it tracks more closely with commodity prices and the CRB than anything else in the world economy, more than U.S. stock markets or any other types of indices, because of this, the importance of commodities. Now, the emerging markets, a lot of people are saying, well, why not buy them? They're undervalued, and developed countries keep making new highs like U.S. and Germany. We're like, no, they're going to end up falling more, probably, than most developed countries, because they're so dependent on the growth of the rest of the world, because they have higher growth rates, because they have higher stock valuations. You've got to remember that in the 2008 crash, China crashed more than the U.S. China's market went down like Greece, almost 70%, and has barely bounced. I've been saying for years that China's stock market is telling the truth about the Chinese economy. They're building stuff for nobody. If a business builds stuff for nobody, has excess capacity, excess debt, and expenses to fund it, they're going to lose money. Well, China's stock market is saying they barely bounced and they're back near their lows. They've been back near their lows for years. They're saying our economy is unprofitable, and without profits you can't sustain growth. The Chinese government is growing at all costs to create fake jobs for these unskilled rural people that they're just shoving into cities, which is going to backfire on them, I think, bigger than anything in history. Chapter 6 of my book goes in this, the relationship between emerging countries slowing, commodity prices slowing, and especially China. China's buying 30, 40, 50% of most industrial commodities and metals in the world, and their export machine is slowing like Germany's and everybody else's. So emerging countries, commodity prices, this is another thing that investors need to understand, and most people don't. They're falling, and they're going to keep falling. I expect commodity prices, they tend to go up for about 15 years and down roughly, and that can vary, but this cycle does not likely turn around until the early 2020s, 5, 6, 7, 8 years from now. Now, look at some other emerging markets. Brazil, here in late October, is down 50% from its high in 2008. China is still down 80% from its high. Gold, commodity everybody thinks is going to save the world, down 36% from its peak at $1,934 in September of 2011. Silver is down 65%, and we told our subscribers in our newsletter to sell gold and silver when silver hit $49 right on the day in late April, because we saw this commodity cycle peaking, and we saw these as bubbles. Everybody says they're not bubbles. They're bubbles. Now here's a contrast. India, emerging country, the largest in the future in population, the best demographics of any large emerging country, one of the least dependent on commodity exports. Commodities are not a giant part of their economy for export, and they're only 35% of their exports, and their exports are not nearly as big a percentage of their economy as countries like Brazil and China and etc. India's stock market, from its peak in late 2007, I think it was, is up 35% at major new highs, one of the few emerging countries. So in our November Boom and Bust newsletter, for people who aren't on it, we had an issue saying India is the next big thing. But don't buy them yet, because the whole global stock market is set for a major reset. I think it's going to come in two waves, as I said for years. A first crash into 2015 or 16, and in a kind of a, let's call it a aftershock crash, 2018 to 19. So we're going to see global stocks go down, and India could be a buy on the next crash because its demographics are so favorable, and it has got a new pro-growth prime minister, which they haven't had in eons, if ever. And China is even looking now at investing in India's infrastructure, and that is a win-win, because China has greatly overinvested and needs some place to put their money. India has greatly underinvested. But the key trend here, don't expect emerging markets to save the world. And if I looked only at demographics, I'd be thinking the same thing. Hey, they got strong demographics with the exception of China. All emerging countries do. India is one of the strongest. But they have this dependence on commodity exports. They have this dependence on world growth. They're like the tail, and the developed countries are the dog. So emerging countries I am not interested in unless they've got very strong demographics and are not as dependent on commodity exports for their growth and their stock market particularly. So I'm not interested in emerging markets until the early 2020s, but I am interested in countries like India and potentially countries like Turkey and Southeast Asia, with everything from Myanmar, Indonesia, Thailand, Cambodia, Vietnam. Those are countries I look at, but India, to me, is the next big thing, and one of the first places we'll have you reinvest after the next crash, after we get this next global reset.